It's a new month here at Henssler Financial, and we found three important things to focus on in the market this month. Number one, credit crunch. Fed interest rate hikes have begun to take their toll on the U.S. corporate sector as bankruptcies have risen rapidly into the middle of 2023. Looking at large companies with over $50 million in liabilities, we have seen the greatest rate of bankruptcy filings year to date since the great financial crisis. Debt has become significantly more expensive, with corporate rates moving from 4 to 6% to 9 to 13%, and the burden has become too much for many businesses. The current pace is concerning, and we will be monitoring the corporate debt markets as a whole into the second half of the year. Thus far, we haven't seen credit market contagion like in prior periods, but it bears monitoring. Number two, the manufacturing puzzle. We are currently seeing two conflicting developments in U.S. manufacturing. On the one hand, the Purchasing Managers Index showed a deeper contraction in activity in June. Production, pricing, new orders, and employment were all down. It appears the manufacturing economy sees some growth uncertainty on the horizon. However, spending on manufacturing construction continues to zoom higher. The current pace hasn't been seen in decades. We see this as a function of reshoring of U.S. production amidst geopolitical turmoil and targeted capacity increases in EVs and semiconductors. It's hard to get a firm read across both slowing activity but increasing investment, and we think the reshoring trend is worth watching. Number three, consumer sentiment. After a bit of malaise surrounding runaway inflation, the U.S. consumer has remained resilient, with the University of Michigan survey showing increasing optimism. The latest report saw the highest level in 4 months, and year-ahead inflation expectations continued to ease down to 3.3%, which should be a welcome development for the Fed. With the employment picture still strong and less sticker shock, we'll be looking for the consumer to continue to drive economic momentum into the end of the year, and current signs look positive. One final thing of note on the consumer is the potential disruption that the commencement of student loan payments in October could cause. Rough estimates show that the pause has been a $300 to $400 per month benefit to those with student debt and could throw a wrench into the spending equation towards the end of the year. And that's been your Market Minute for the month of July. Thanks for listening.